Hey guys, welcome back to the channel helping you earn more, spend less, and invest the difference. Now, as a general rule, people say you should never mix business and pleasure or go into business with family. And I get it, there can potentially be some downsides to going into business with your family, but there can also be some stupidly powerful benefits to being business partners with your family members. So let me explain. But before I explain, I need to throw out the standard disclaimer that I'm not a lawyer, I'm not a certified tax professional, any information is for entertainment purposes only. I'm just a guy on the internet, so consult your own professionals. Now, the reason being that business partners with family can sometimes be super beneficial is because it can open up an enormous class of tax loopholes for you to exploit. Over the course of your lifetime, taxes are easily going to be your single largest expense, more expensive than your mortgage, your food bill, your health insurance. Taxes is your single biggest expense in life. So if you can find loopholes and take advantage of those loopholes the same way that rich people take advantage of the tax code, then in the long run, you can save an enormous amount of money. So let's take a look at a hypothetical example. Let's say that you, your spouse, your brother, your sister, your mom, and your dad all get together and form a business. Maybe you do a partnership or create a multi-member LLC or whatever it is that you guys decide. Now, maybe you all own an equal share of this business, or maybe some people contribute more and own a larger percentage than others. However you guys want to structure it, it doesn't really matter. But for the purposes of this video, let's just say that you all own 1/6 of the company. So let's say that each of you is supposed to contribute $10,000 of your personal money to the business each year. So each and every year, you and everyone else, all of your other business partners, you all contribute and give the business 10 G's. So now the company has 60 grand. Now the business goes out and gets a loan and buys some real estate. It buys a rental property. Now you guys don't have to do real estate. You could do another business. It doesn't really matter. But personally, I like the idea of a family real estate business, and I'll explain why in just a moment. Now, if you're all contributing $10,000 per year, you can probably get new loans and buy a new property each and every year. No more needing to save up forever so you can afford the 20% down payment required to buy a rental property all by yourself. By partnering up, you can start buying properties immediately. But theoretically, you could partner with anyone. So why should you partner with family? Well, the simple answer to that is that now family isn't just family. Now family is also your business partners, which opens up a whole new realm of business tax deductions when you interact with your fellow business partners. So what do I mean by that? Well, maybe you have a family tradition every year for Christmas that everyone flies home for a week and hangs out at mom and dad's place for the holidays. But now that your family members are also your business partners, now it's not just flying home for the holidays to be with family. Now it's flying to your corporate board meeting to discuss which real estate property your business will purchase in the upcoming year. Now suddenly it's not a family vacation, it's a business board meeting that is conveniently hosted annually in late December. And as such, the cost of your airline tickets are no longer a personal expense. Now they could easily be considered a business expense and thus qualify as a 100% business tax deduction so that you can meet with your other family members, I mean partners, to discuss your next purchase. But it gets even better. Now instead of everyone crashing at mom and dad's spare bedroom when you go home for Christmas, your business can actually rent your mom and dad's house for up to 14 days under what's known as the Augusta rule. Using this IRS tax rule, your business can rent from your mom and dad. It rents their house for up to 14 days and use their house to host your corporate board meeting. Sounds kind of strange, but it's completely legal. By having your business rent the house from mom and dad, it creates a tax-deductible lodging expense for your business. And the best part is that mom and dad don't have to report any of this income from the business on their personal taxes under the Augusta rule. So what you've done is you've essentially created a lodging tax deduction out of thin air for your business, because your business gets a deduction because your business paid rent to procure lodging for its board members, but absolutely nobody is required to report the income. Your business doesn't report the income, it paid the money. Mom and dad don't have to report the income. Literally, nobody reports the income, and it's all 100% legal under a little known tax law called the Augusta rule. If you're interested in learning more about the Augusta rule, you can check out this video right here. And while your team is at this corporate board meeting that is hosted annually in December, if your team goes out to eat, that meal might qualify as being 50% tax deductible as a business expense, so long as you follow the proper IRS rules for claiming meals as a business deduction, such as, actually talking about business stuff during the meal. And the great thing about real estate is that you don't have to buy real estate in whatever geographic location you are in. You can buy properties all over the United States. So if at your next December board meeting at mom and dad's house, if the team decides that Orlando, Florida is a very nice spot and is worth investing in that area, well, then it makes perfect sense for the team to make a trip to Florida to scout the area. You see, taking a family vacation to Orlando to go to Disney World isn't a tax deductible expense because family vacations are a personal expense. But if your team flies to Orlando, or a representative or two from your team flies out to scout and buy real estate for your business, then that trip is a legitimate business expense. And while you're in Florida, if the team just happens to make a side trip to Disney, well, then that's just convenient. Maybe next year your team decides to buy something in Las Vegas. And if you just happen to stop at a casino to have some fun after looking at houses all day, well, you get the picture. And you know what? Maybe 3 years later, you're interested in seeing how your investment is doing. I mean, you need to check up on your business and make sure it's running smooth, right? So maybe a few years later, you fly back to Vegas for a couple of days to look at the rental property your team had previously bought. So you go and you check out the house, you check out the neighborhood, you talk to your property management team, etc. That's a legitimate business tax deductible expense, and if you just happen to see a show on the Vegas Strip later in the evening, then that's just a bonus. And the bonuses keep on coming. Maybe someone in the family has a teenager. You could theoretically have your business hire this teenager to do work for your company. Maybe you're remodeling a home, so you hire them to do some basic demolition and, clean up the place a little. Maybe you hire them to do some research online. Maybe they're tech savvy, so you have them set up an online advertising campaign. Some of those We Buy House type of ads. These wages are a legitimate business expense, thus reducing your company's taxable income. But the best part is that chances are this teenager isn't going to have to pay any taxes on this income. You see, as long as they earn less than the standard deduction, which for tax year 2022 is roughly $13,000 per year, as long as they make less than that, they won't have to pay any income taxes on this money. This method is called income shifting, where you take income that would have otherwise been taxable for the business and shift that income over to a child who doesn't earn enough overall income to be required to pay any taxes on it. Now, obviously, being in business with family has its downsides as well, but as long as you guys can overlook the minor things and focus on the big financial picture, then going into business with your family can be the kind of catalyst that creates generational wealth for your entire extended family. If you enjoyed this video, consider subscribing, and as always, I'll see you all again next time. Thanks.